You are entering an investing state of mind the system doesn't want you in. The truth. You want answers? Michael Covel has them on the trend-following radio network. And now, reaching over 130 countries and territories, Michael Covel.
My guest today is Steve Burns. This is Steve's third appearance on my show, I believe. And I was trying to think, what's the best way to describe Steve? Because believe it or not, even if you've not heard of Steve Burns, Steve probably has more fame in the, quote, new internet of finance and trading and investing than many of the well-known names that exist from back in the day, perhaps even in the Market Wizards books. Steve has single-handedly developed an exceptional Twitter following, self-published multiple books, and keeps a forum running straight on the arrow. A really fascinating unfolding of a career because it reminds me of myself in some ways. And I know damn well that if I had to start over today, given the publishing world, I'd be going the self-publishing route too. So I think there's quite a bit to be learned beyond our conversation that Steve and I are going to have today. There's quite a bit to be learned just from a marketing perspective on how Steve Burns is navigating all digital platforms today in 2015. There's something to be learned from Steve on that front for sure. Today, our conversation is about trading on assorted levels. But Steve does have one primary focus. He likes to focus on new traders and really dispelling, frankly, bad ideas that people have. And people have a lot of bad ideas. I can sometimes get too highbrow on my podcast, but I like sometimes that Steve reminds me that it's smart to break things down for those that are starting out. Also today, part of this is some Q&A, some questions that were sent in to Steve that hopefully both of us can answer in some kind of coherent fashion for you, the audience, today. I hope you enjoy this conversation with Steve Burns. Hi, Steve. How are you?
Hey, all right.
I'm trying to think, has it been about a year? Longer?
Yeah, I think it's been longer than a year.
I feel like I'm on the podcast treadmill. That's not not a complaint, but you just sometimes lose track of time.
Yeah, you've been cranking out the podcast. It's been amazing.
Yeah, it's been fun. It's been, it's like being in school. I mean, like a special kind of school with really interesting, smart people.
Yeah, the people you interview, it's an amazing list.
Yeah, it's a fun crew. I was thinking we kind of exchanged some notes and some ideas, and we got some, quote, audience feedback type questions from your audience. Some good questions here. One of the things I wanted to start with, well, first off, I want to make a point, something in observing what you do in your career and your business, because it reminds me a lot of me. But I think what's interesting about what you're doing right now is that when I put a book out for the first time, no name author, 2004, first book, and it was with a publisher. And today, I definitely can't see the benefits to the publishers. I just don't know what their benefits are, unless you happen to be like the Harry Potter flavor of the month. And it looks like you have, via trial and error and experience, you have kind of figured out, where it looks like you're making a bet on yourself and saying, you know what, I'd rather do my own thing. I'll have my audience. I'll publish the books as I want, but you don't seem preoccupied with chasing a publisher. Now, you might tell me now a publisher's come knocking on your door and they want to pay you a lot of money. I don't know, but it seems like you have gone about this distribution path in the right way, considering how things have unfolded in the last 10 years. The whole game's changed.
Yeah, I agree with you completely. I think Amazon's going after the publishing industry now because like you said, we were able to self-publish the New Trader 101, and we got #1 on stock market investing twice, and we've been in the top 20 consistently with no publisher. It's just a better model. You keep all the money for yourself. You don't have to go through all the rigmarole. And you were part of the inspiration for me doing that.
Well, I mean, I haven't done it yet myself. I've worked with a publisher each time. I'm definitely the project that I'm working on right now. Maybe after a certain amount of success, fingers crossed, knock on wood, I would go with a publisher, but I definitely will not out of the gate go with a publisher next time. There's just no way. It doesn't make any sense.
No, not with today's technology and the ability to self-publish yourself. I mean, I'm with you. I don't understand anymore, all that work.
Yeah, and I think also too, the creativity aspect, let's say you want to have a book or a project that has some element of creativity to it, perhaps color or perhaps designs or whatnot that go against the grain. There is no publisher out there that thinks like that in the trading and investing world. They just think like, give us the black and white printed pages, and just like every one of these books that have come out for the last 100 years, you're just going to be next in line. That's not necessarily a bad thing. And of course, some guys and gals have sold millions of copies and it's worked well. But it's not that time anymore.
Yeah, you're exactly right. Especially with the Kindle. The Kindle versions now overtake the old $30 paperback hardcover. I mean, it's just a different model now.
Yeah, I don't personally like the Kindle stuff. I don't feel like I comprehend, or I don't feel like I value it as much. But that's just me personally. When I look at the audience out there as a businessman, you have to say, well, whatever your personal preference might be, the audience is saying loud and clear, we like Kindle.
Oh, absolutely. That's what I said. I'm the same way. I love having the paper book in my hand and reading it. I feel like it's a different experience, textile experience, but you can't argue with the sales on Kindle.
Yeah, no doubt. No doubt at all. Hey, listen, before we jump into some of these questions, and I kind of got a list of questions from some folks that were on your forum, and I pulled some stuff off your Twitter that I thought was interesting to me as well, that I think you'll have some feedback on. But one of the things I wanted to jump into in the very beginning, and I think this is actually an issue from you that you were addressing, not necessarily the audience, and you were talking about an area of interest for you to talk about, is social media and how to filter out all the stuff online. How does one go about making choices? I personally don't pay attention, but I also have the advantage. I have the advantage of not starting out today. I don't know what would happen to me if I started it out today. I mean, because you're bombarded. How do you know who to choose from, what to choose from? You see a lot of this because your forte is with the new traders, helping people that are literally like walking into this world for the first time.
I think the biggest thing to watch out for is the more somebody promises, the more danger there is. I mean, the quickest way to go broke with your trading account is to follow those who promise you a get-rich-quick scheme. I mean, really, risk management has to be the first step. And if they skip risk management in their trading process, then that's somebody to avoid immediately. It has to be somebody who stresses their own personal picks or their own personal opinions over a trading system that works is another big warning sign for me. And that's what I try to do is get the new traders and show them, what to avoid based on the warning signs. And you just don't know, Michael, how many just endless traders try to go in the trading world and just blow up their accounts within months, if not first year. Just go from, whatever they start with to close to zero quickly. Through simple not position sizing correctly or even understanding it.
Well, yeah, I was going to say for many, look, not even new traders, just so many investors out there. I mean, if I was in front of an audience and I said, hey, this could be a show of hands of very accomplished people, 300 people in an audience, and say, what would you propose as the best percentage to bet on each trade? I literally had hands go up and say 10%.
Yeah, it kills me is the 1% rule. Like, they don't even understand. They can't grasp what I'm saying. The majority of the new traders, they think the 1% is the position size. So they don't know the 1%, is the capital you can lose in your total account. And they don't understand what that even means, and or they're trading at such a small account that they think 1%, that's not even worth the time or trouble. It's like the trouble is that your account's not the right size, not that the 1% rule is flawed. Because mathematically, they go into, like you said, the 10% per risk. They're going to blow up mathematically. It's almost certain within the first 6 months.
I mean, there's always going to be a story of somebody that gets lucky. There's always the needle in the haystack, the lightning strikes. But I think randomness, that's not a plan. Just you can find somebody on the internet that has some random lucky success. And that's not necessarily saying that luck is bad. I mean, for example, in 2014, you have to be lucky to have crude oil move like it did, but you also have to have a system to capture that luck. So it becomes, I think one of the things, and I'm curious your opinion on this, one of the tricky things in so much of my world, systems, trend following models, very similar in your world too, is getting people to understand and break free of the grasp of fundamentals. That the desire to, if I know more information, that will translate to a better buy, sell, sizing of my trade. It's very hard to get new traders to understand that, isn't it?
Yeah, and until they can find a market they can trade fundamentals on, they're going to have to trade price. That's the only thing that's going to pay them money. It's funny how they just can't get over that obstacle. And fundamentals are not the way you're going to make money in almost any instance. It's always the price that's going to pay you.
When you see it too in so many walks of life, you see it in sports these days, sabermetrics. You see it in basketball analysis. You see it in the VC world, in film financing. Everyone's talking about numbers. But then when it comes to investing, it's like we turn off our desire to get scientific and we want to still be like in fantasy stories and like bedtime stories and stuff like that.
It's like across all, even religion, politics, it comes to people's beliefs and what they think something should be valued at based on what it actually is valued at. It's a really strange dissonance that they carry on in all walks of life. Like you said, the Moneyball is a great example of that. Instead of quantifying what works over just what was taken as common wisdom. I love that movie.
Yeah, it's great. Whenever I turn on the tube, if I'm flipping channels and I see it, you always stop and you watch it because it's engaging. And to me, I still see that and I'm like, my gosh, if people love that stuff, and we're just talking about guys. If guys love that stuff, you would think if the vast majority of guys that watch sports or engaged in the latest sports metrics, liked Moneyball, they absolutely would love systems trading, models, and trend following. It'd be right in their wheelhouse.
Absolutely. What I find funny, the ones that do not manage the risk, the ones that don't manage risk and they just carry on with their opinions. And like you said, that's where the survivor bias comes in. I'll have some guru will say, hey, these two guys made multiple six figures in my trading. Look, that proves my case. And then I will say, well, what about the thousands and thousands and thousands that blew up their accounts before making any money? And they never did because they quit because they were mentally ruined with the system, much less financially ruined. But they try to point at a couple of people, like you said, they got lucky. They bet 10% a few times and they did win and they made money. But that's the rarity without risk management. But that's where the survivor bias lies, is in the lucky ones. And then it's so odd to me is looking at the trading world is the ones that did overbet and got lucky, they eventually blow out generally in future, even if they win in the present moment without risk management.
Survivorship bias brings up an interesting issue, especially like in my world, because I was always fascinated. I wasn't fascinated by one very famous investor and, okay, now I'm going to construct this story to explain this one guy to everybody. I was fascinated by the fact that there was all these different people, unconnected, going back decades. Many of them did not even know each other. In fact, this might sound crazy and I'm not trying to like toot my horn, but I've literally been in the same room and introduced some of these quote names that didn't even know each other. And I was the linchpin of saying, hey, do you guys know each other? I mean, it's like, it's almost like this great story of all these people on a desert island figuring out, and I'm just talking about trend following right now, for example, figuring out this cool strategy. And there was many of them. And that was always engaging. And I would think in your world, when people start talking about strategies, if they can't like name a list of people that have done it already. I mean, you don't want to just see like one crazy crackpot with some one strategy. You want to see an army of people that have been doing this.
I don't know if you found in your own, when you've reviewed the trend followers, found that a lot of them, like you said, that don't even know each other. Like, 'cause I know people in a lot of different schools of thought for trading that make money, and it seems like the discipline, the risk management, the position sizing, the capturing trends in their time frame, maximizing winners, minimizing losses. That seems to be the common thread across all the different systems that made money that I've seen. And it's like, it's a formula that they have. Like you said, they don't even know each other. They're even trading different methodologies, but they're all based on capturing a trend in a time frame. And it seems like they all have those similarities across methodologies.
I think that's a fair assessment. And I guess it becomes tricky because there is kind of a classic, quote, trend following approach, but then there's other approaches that are using very systematic entries and exits. And there's no running away from it. Position sizing is position sizing. You know, there's no special position sizing based on the entry or exit you use. I mean, it's all pretty, it's out there. I mean, everybody can figure that out and understand what it is, but I think you're right. Everybody's trying to capture a trend. Nobody can predict tomorrow. And that's where we're left. That's life. That's life.
And the trouble gets into when they start wanting to predict a future that doesn't exist. They want to trade. They have so much conviction, they call it, on a trade that they go in really, really big. You know, then they have the losses that work against them because, you know, compounding back up is different than compounding down. You know, they lose 20%, they got to make 25% gain to get back to even. They lose 50%, they got to get 100% to get back to even. So they get in this negative spiral that I see. It's sort of the opposite of the winning ways. They have the losing ways. And that seems also be consistent across the trading world to the retail level.
You know, I got a question here. I actually got a bunch of questions here. People that asked some questions on your forum. A gentleman named, and I hope I don't mess this name, so don't yell at me, Tevik, I believe. And essentially his question is like, look, I'm a relatively new trader. I've gone through a bunch of different strategies and he knows that it hasn't been good. And he's kind of asking about a fresh start. What would be your advice?
I think the place he has to start to build a methodology, and there's no magic in the system. The magic is in creating something that gives you an edge. You know, you start with a 50-50 coin toss, and then you increase your odds of wins by looking at the trend inside your time frame. So that can increase your odds better than 50-50. Then you look to where your stop loss should be when you are going to be proven wrong in a trade or proven that the entry is invalid and you have to exit. So you find a place where you're proven wrong and you work from there. And there's no magic in the thing. The magic is in finding the one that works, that back tests properly across charts, that you know works, and you stick with it and you trade it with discipline. And I think that's just, he has to develop an edge from the beginning and then trade it and quit looking for the magic. That's probably where people go wrong.
You know, he also talks about something in there, and I think this can be parsed, and maybe people can say something different and they actually mean the same thing. But he says, quote, perfect fit for my personality. And that always strikes me because I wonder when I watch, and I recently watched a couple-hour interview with Jim Simons of Renaissance Technologies, I don't necessarily get the impression that he was thinking about his personality when he was developing his trading models. I think he probably had a philosophical view of what was taking place in the markets. He had some experience in fundamentals that had gone bad. Then, based on that philosophy, his worldview, he said, well, how can we build models around that? I think it's really tricky with the personality part because if you just say, well, first off, who in the heck has got a great measurement for personality? So that this is like some self-measurement. You know, I think I'm personality A or personality B. This is like hocus pocus mumbo jumbo. And I'm a guy who's qualified to administer the Myers-Briggs personality instrument. So I just don't know how people are supposed to decide what my type of personality is. And then even if you did, it's kind of predicated on, well, if I know my personality, then there's an assortment of strategies I can choose from that then fit my personality. There's absolutely no evidence of any of that either. So I really think the personality aspect, and you're welcome to kind of beat me over the head and disagree, but I really think the personality aspect gets overrated because it's just not quantified. There's no evidence for this. Whereas there is evidence, as you've been talking about the systems, the rules, the edge, position sizing, there's evidence for that.
Yeah, I think the quantifying of the personality is what really people it really makes it go into mumbo jumbo land. I think the keys are you have to have a personality of an entrepreneur to be a trader because the money is uncertain. I think you have to start out with an entrepreneurial personality at the first. I think the real key though is being able to tolerate the heat of whatever you're trading. I think you have to have the heat tolerance for drawdowns. I think that's the one big thing that if you're going to be aggressive and go for a 30-40% gain, you're going to have to also be able to mentally and emotionally deal with a 30% down system sometime of the year. So I think the heat tolerance versus a return aggressiveness is really and like you said, you can't really quantify that. It's easy to give up mental ruin point where somebody's down 25% in a large trading account and they just give up because they just can't mentally and emotionally handle it. I think that's about as close as we can get, but even that's hard to quantify. But entrepreneurial personality and heat tolerance, I think those are the two things that matter to people.
I look at, for example, a trader that I've written about named Bill Dunn, and there's no doubt in my mind that he just looked at it early on in his career and he understood the math of it. And he said, okay, I'm going to take these steep drawdowns because I want the 20% plus compounded because I'm playing the game to get super rich. And I think that's a personal choice everyone has to make. There is absolutely no way that you, Steve, or me, Mike, can say to somebody, hey, you should risk this percent, or you should be shooting for this type of gain with this type of drawdown. That is always going to be a personal choice. There's absolutely no way that anybody can tell you that. And, that's not the system. That's the money management. That's like as you say, the heat. How much can you take in your gut? And you have to decide what you want. It's like deciding what somebody wants in a lifetime. How can you tell them? How can I tell them?
Yeah, I think, like you said, it's the faith and confidence that you have back tested, you have studied of your philosophy on the market, and you see what works over long term and over different market conditions, and you have that faith and confidence. Like you said, it's a math. You have the mathematical knowledge of what you're doing to know what will happen, and it carries you through the heat and the drawdowns.
Jeff Waters asked about one of the questions. He talked about mindfulness, and I've had some people on my podcast, Andy Puddicombe, for one, that talks about mindfulness. And this is another one of those ones where I don't think there's no necessary one way to go about it. But for me personally, I find the writings of Alan Watts to be soothing. So, for example, there's a book I think it's called The Wisdom of Insecurity by Alan Watts. I hope I'm remembering that correctly. But that's just a fantastic read for investing. And he doesn't talk about investing once in the book. Talk about mindfulness from your perspective.
I think that's what trips a lot of people up is the traders, and they get into whatever they're doing with their monitors and the price is moving, and they're feeling the pain of the money as it leaves their account and goes in their account, and they're having the emotional ups and downs. And I think they lose the mindfulness of the math. They get into swept away by the emotions of the fear and the greed and the ego, and they want to be right versus they just want to trade their system and let their methodology play out. And I think that's where people really get messed up. And part of that is, like we talked about before, position sizing. If somebody is trading risking 10, 15, 20% of their entire account on one trade, then they engage their fears and their ego and their greed and their emotions and their thoughts are so loud they can't even hear their trading plan. They can't even do the math because they're swept away in making decisions in the moment based on a fight and flight mechanism instead of just simply executing one trade that should have little meaning in a long-term methodology and system. And losing the mindfulness, like they should know exactly what their goal is, what their loss is, what their position size is, and it's simply execute their plan. And when they engage their fears and greed and ego, then they lose track of that.
And I look at his question, and he's talking about when a trade goes against the trader. And I'm thinking, well, my first thought is, and breathing exercises for when that happens, and think, well, hold on, the breathing should be consistent. whether you're up or down. I mean, you shouldn't. That's the whole point. You really want to be consistent. But I think also the idea of fixating on when a trade goes against a trader, to me, and I'm not saying this, he necessarily said it this way, but it seems like a fixation on a fact that you already know is going to happen before you start trading. So why are we from the very beginning already allowing ourselves to get worked up about trading losses when, for example, if we were talking about a trend following type strategy, you could have 60 or 70% losses. Why are we already from the beginning fixated on something and worried about something that we know damn well is actually part of the strategy?
Yeah, that's another strange thing is these people, a lot of people in the retail trading world are wanting, high 90% win rates, which is virtually impossible. I mean, most great traders have a 60, 70% at the most win rate. And the losses, like you said, have to be expected. I mean, one loss of 1% of your capital is simply one trade of your next 100 trades. And it's simply part of the business you're doing. That's just, trading is different than the other professional fields where you can expect to be wrong most of the time. It's the times when you're right that you maximize where the profits come from. But like you said, I mean, I fully expect, I have no tie to any trade. I put a trade in, I have my stop loss level. I'm looking for the trend to capture. If it doesn't happen, it doesn't happen, and I move on to the next one. And that's just business.
I think it's that right part, because people, they want to be right. And you can so by fixating on the losses from the very beginning, you're subconsciously saying, I can't stomach the idea of not being right. And so if you turn it on its head and you remove yourself, and this is almost a mindfulness type thinking. If you turn it on its head, remove yourself from all the action, don't pay attention to the news. Frankly, don't pay attention to too much what's going on online, and just develop a system that you know is what you have to follow and stick with it. There's your secret sauce, if there ever was a secret sauce.
You're approaching trading with equanimity. You're just letting the trade. You're just executing a trading system. You're just going with the flow and accepting whatever happens. You can't force anything. You're just trading the math.
Michael Panico, again, I hope if Michael, if I messed your last name up, I mean, look, people mess my last name up all the time. I don't know here. But Michael's asking about back testing processes. And I think the most common one out there, well, there's quite a few, but trades, I mean, and there's no secret here. TradeStation, MetaStock, Wealth Lab, frankly, if you can code Excel, there's no real secret. And I know a lot of the brokers will have these days, will have some type of engine often associated with their platform. So there's no grand secret there, really, is there?
Yeah, I think some traders might not back test under enough market conditions where they may think they have an amazing system and then they fail to back test through the 2008, early 2009 meltdown, and they may run into trouble. Or they may not back test during the 1987 Black Monday, might have blown them up. I think when they're back testing, it's got to have a large enough sample size to look through bull markets, bear markets, sideways markets, the black swan events here and there. And I think they just have to make sure they're covered under all those conditions. I see people that are looking at back testing just for the last few years since the 2009 bottom, and they're going to get different results than they would have got during, 2000, early 2003. I think that's just covering all market conditions.
Somebody's welcome to disagree with me, but I've not seen evidence yet of the pro traders, the legendary traders that everyone knows. I've not seen evidence yet that their foundations are based on backtesting one market in isolation. And I think that gets to a whole nother issue, which, having a quote favorite market, there really isn't any logical sense to have a favorite market. I mean, if you, the trader out there, if you made all your money in pork bellies, you made all your money in, the S&P, I mean, for that particular year or month or whatever, who cares? Why is it relevant?
It's interesting that the principle is going to be applied across multiple markets. usually the really good principles of, is all is supply and demand and trends, and that applies to all markets.
Yeah, and it's tough though for people because they want to think, if they hear the S&P and they hear pork bellies, they think, well, maybe I could trade the S&P, but I can't trade pork bellies. I don't know anything about that. Well, you really don't know anything about the S&P either. I would argue none of us do. I don't. No one does. But you could trade, as you say, it's all supply and demand. It's human behavior. You're essentially attempting to navigate. Let me go into, Rick brings this up. Rick Smallwood brings this up. And he wants us to talk about a lot of different things, traveling overseas, probability, psychology, behavioral finance, economics, or fishing. I don't have any good fishing stories at the moment, except that I do eat a lot of sushi. And traveling overseas, if all I can say about that is if one has not been doing it, then it is really easy to fly out of America and land your rear end somewhere in parts unknown pretty quickly. Within 12 to 14 hours, you can be in the middle of something that you would never expect yourself to be in the middle of really fast. But
you do that, huh?
Yeah, the behavioral finance aspect, the behavioral economics aspect. I've had a lot of people on my podcast talking about behavioral issues, some of the really bright people out there. It's really interesting, I find, about they've all figured out that we do everything wrong. We have biases. We don't use good heuristics. We make bad decisions. And literally, it's all about having rules. I mean, that's what the behavioralists have really given us insight into, is have rules and stick to those rules.
I think that's the most powerful thing about trading rules that people don't understand, is it helps you overcome your normal bias, and rules help you overcome your ego, your fear, your greed, and quit making psychological mistakes in your trading. I think that's huge with behavioral finances. The rules enable you to overcome your weaknesses, your psychological weaknesses.
I saw it on your Twitter feed. You had a triangle, and the base of the pyramid was the first third. The base of the pyramid was 60% psychology. The next third of the pyramid was going towards the top, 30% money management, and then 10% strategy at the top. And there's a lot of different ways one could imagine that, but I think the overall point someone should take away from it was, Mike, Steve, the two of us could sit here and talk about technique and math and probability and profitability and all this kind of stuff. But at the end of the day, most of good trading is out there. I mean, the rules are out there if people want to. It comes down to, that area in your stomach, that pit. Mm-hmm. That's where it starts and it finishes there ultimately. Even if people don't really want to admit that, it really is psychologically driven.
Absolutely. That's what makes all the difference in so many ways. I mean, if you have the psychology and you have the risk management down, then all you do is develop your system. If you don't have the psychology and the risk management, nothing else matters.
Yeah. Hey, let's talk about mentors. Young Lee asked about mentors. Interesting and difficult subject. I just had two young guys on a podcast episode I made live the other day. And one of them had reached out to a couple well-known traders and got some insights. Another had kind of been in the business in the periphery and worked his way in. But it's tough because, you really can't substitute. There's so many voices online. And those voices really aren't mentors. They're just people. A mentor is somebody that you really trust is giving you foundational guidance, knows something with some credibility and evidence behind him or her that you can really believe in and that you could go verify. It's like the old Reagan-Gorbachev thing, trust but verify.
Yeah, I got so much from your book, Trend Following, and Jack Swager's Market Wizards series. And it's like you said, you can pick up so much from those books, but having that one-on-one person who, like you said, has done it and can give you the instant feedback that you trust can make a huge difference. And there are people on social media I've seen, they've met each other, and people have developed mentors just from meeting online through Facebook or through Twitter. And it helps speed up the trading process dramatically when instead of you trying to go through trial and error for a year, your mentor can just tell you something and speed up your process. But like you said, it's a trust and verify, and they got to be really careful who they trust.
It's really tricky as I think about this conversation we're having today. We're covering a lot of different angles and different territory, different perspectives. Is for a brand new trader to really sink their teeth into the idea of what a model is that loses 60% of the time. I mean, that's got to be, it's second nature to me today after a long time. But when I first started out looking at this, I would just shake my head for months because I didn't have this mentor initially. And I was like, what the hell is this? This doesn't make any sense. What are they doing? You know, because I'm just thinking Warren Buffett.
Yeah. Everybody, that's the old default thing. They think Warren Buffett and value investing. Well, they don't know how many other derivatives he trades and the other things he does with how it's funny to me. You ever look at Berkshire Hathaway really went wrong for him from the beginning when it was a textile company, and it was a huge error he made, and he ended up fixing it by creating a holding company and an insurance company and turning it around and making a corporate conglomerate. I thought that was amazing that Warren Buffett was wrong about Berkshire Hathaway. It was a failed textile company. It wasn't coming back, but he quickly shifted and changed it.
It's a great story. And I think every American is proud that he's an American, that he's had, you can say, oh, there's a fellow American and look how successful he's been. But it's amazing, at least in my particular world, I've seen so many criticisms over the years about, Mike Covel, you picked these lucky survivors in the trend following world and you ignored all these others. Whereas I really try to find a broad cross section of people. But if I flip that around just for a second, not to, run away from that criticism, but to look at the most famous American investor and say, my gosh, though, isn't he the greatest example of being the survivor? And he would admit that he's lucky too. I mean, he's already said I'm lucky by birth, but he's got to be the greatest survivor. And how we've come as a society to literally look at this one man and just say, we're all trying to be like this one guy who arguably is just the luckiest survivor of them all. And that's not to take away anything of his success because tremendous success.
And it's the same thing with, so many of them, but the survivors in the trend following world, they were all the ones that were doing the right thing. The survivors that you've interviewed and saw, they all had the same they had parameters of risk management, perseverance, disciplined approaches, capturing trends, letting winners run. I think the survivor bias, which, we hear all the time, even with the Market Wizard series, is they did have some things in common, and they were the survivors because they had the risk management in place to be the survivors. I think that's what separates that. A lot of the ones that didn't survive you never hear about were the ones that didn't have the right position sizing, and they all experienced a risk of ruin. Even the huge funds like LTCM and Amaranth, they all did not respect the risk of ruin and were ruined. The survivors did respect the risk of ruin.
Yeah. And look, I've seen it without naming any names. I've seen all kinds of things behind the scenes. And look, there are traders out there that people perhaps know of from a distance. And some of these stories, once you get behind the scenes, are absolutely just not factually accurate. And that's the tricky thing for people out there is how does one dig? And again, this starts off the beginning of our conversation. How does one dig through all of the info and data and opinions and this and that and really try to find honest voices? And that's honestly what I try to do in my podcast. I try to find people to the best of my ability that I think have got a foundation, a CV, a resume, so to speak, that when we listen to them, not that they're necessarily, including myself, that we're perfect, but that we are trying to give as a robust of understanding based on what we know as we can.
So that's why I like to start from the top and work my way back. Look at the successful traders, like all the ones featured in your trend following book, all the ones featured in Swager's Market Wizard series. The Paul Tudor Jones, the people, without his political beliefs, but the George Soros and the ones that were the big winners, and then look at them and go work your way back and see, who wrote about them, who studied them, who interviewed them, get the information from the actual sources that are the best in the world. And I try to do that, a top-down approach.
Yeah, it's really interesting about talking about survivor issues, and to bring up one of the critiques of trend following years ago when John Henry had like a 25-year successful run. And look, there's another element here. When you look to pro traders for insights, one has to properly understand that assets under management is not trading. That's the money management game. And that game can be dicey, to say the least. The game of attracting and keeping assets under management can be terrible. It's an entirely different game. It has no interest to me, frankly. I mean, I use the great trend following traders that you can find in the public world as a proxy to understand strategy. But their assets under management game is not my interest. But if we look at John Henry, so here's a guy, he does his 25-year track record, very successful. And I think for a while there, you would, trend following is dead. Look, John Henry's not doing this anymore. But he didn't lose all his money. He left the industry. He then happened to buy a baseball team and make even more money. And what's really interesting is that, frankly, at that moment of time, you then see all these other traders in the trend following world taking off, like David Harding, like Ken Tropin, who actually was the president of John Henry's firm, and Ken Tropin today, who runs a money management firm that happens to have a significant portion of trend following at it, which has more assets than John Henry ever had as a trend following trader. So it's one of these things where I think people need to always, and I keep talking trend following, that's my world, but people need to kick that can opener and get under the hood and try and look at all the different factors going on, and not just assume they saw a headline. Oh, I know what happened now. I saw the headline. That's not how it works.
That's amazing to me. They'll have a 2-year record. Trend followers will be flat for a year or two, or some certain trend followers, and then they jump on the trend following's dead instantly. It's like, good gracious, these people, a lot of these guys have 20, 30, 40-year track records.
Yeah, it's crazy, right?
And have the recency bias.
And then that was what I always put these track records in the books that I did, because I was like, well, this information is just fascinating, that you could take these monthly track records and you can see the ups and downs. Like there's no ambiguity. It's like right there in your face. You know what has happened in their lives.
Yeah, that's what the problem with social media is. It's so instantaneous, and then when there's even a range bound month or some volatile action, everybody's so recency biased on social media. They're looking for these monster trends all the time, and that's just not how it works. And, they don't look at it. I look at time frames of, a year, annual returns or a decade of returns. And then so many people on social media looking at this month or this week. They lose, they don't have the right perspective for trading.
Yeah, that's just, you're not saying that's the wrong thing to do. I'm just, as you say that, they're only looking at a week or a month. My gosh, if as Steve says that, just, if you are doing that, just stop. You're going to have a nicer life if you just don't do that anymore. Right? It's true.
Yeah, this is a long-term endeavor. This isn't a short-term endeavor.
So let me ask. So Mike Nelson asked about, what is the one trader method that has made the greatest impression on you? The floor is yours.
Well, it has to be trend following, of course. But I learned so much from trend following, the trend followers, your book, and how I've made my own money in the markets. I think one of the things you said, I think in one of your books was trend followers are those that use reactive technical analysis to trade the markets. And when you go from predictive technical analysis to reactive technical analysis, you change everything overnight. You're not trying to trade based on a non-existent future. You're trading what is happening right now.
Why don't you break that apart a little bit, though? And then I want you also to talk about your favorite trader out there that you've really loved in terms of his statements and writings and stuff. But why don't you break that apart a little bit more, the reactive versus predictive, because that might just go over some people's heads.
I think for a simple instance would be, say it's during the financial crisis, at some point during some markets, it's under the 200-day moving average and it's extended. So you can believe that it's going to go back over the 200-day. It's oversold. It should revert to the mean, and it should trend back up near all-time highs, whatever the market is. So you think, I'm going to buy now, and I'll make money when it goes back up over the 200-day and trends upward. And you just believe it will, because that would be crazy. How could Ford go to 99 cents, or how could Citigroup go to 99? That's impossible. So I'll buy and it'll go back up, when it's low. And you believe that. That's one way. That's predictive. But then it never goes back up. Some of these companies actually went bankrupt. It continues to go down to places that people didn't even think was possible at the time, where entire Dow components are going belly up and becoming insolvent. So you end up going long, thinking it's going to revert to the mean, and instead you lose everything. As opposed to, you would say, if it breaks over the 200-day, historically, that has led to the beginning of an uptrend in the majority of circumstances. So you put your buy when it closes above the 200-day. Let's just say, for example, 3 days over the 200-day, you'll go long. And that would be a reactive if it happens. But it doesn't happen, so there is no long signal, so you don't ever go back long that market. So it's a difference between predicting and reacting on price. Let price action show you where it's going instead of predicting where it's going. And it can save you so much.
You're pretty notorious for posting, I've seen on Twitter and whatnot, these pretty funny charts where there'll be 6 million indicators of, lines going up, arrows going here, candlesticks there, some kind of who knows what wave taking place. And I think it just pokes fun at the idea of that's just not the way the game is played. But man, that stuff's seductive. People love that stuff. They just think, when people first get exposed to technical analysis, it's absolutely not via reactive technical analysis. It's via the many books out there that purport. And honestly, I think when I first read about John Henry, he mentioned something about Gann. And I'm telling you what, I probably went out and bought a bunch of these damn Gann books. And I'm reading these things thinking, this is the biggest bunch of bullshit. This makes no sense. But it took me a long time to finally realize that, maybe Henry was just reading about Gann. It was inspired by a technical analysis, but that wasn't the direction that he went in. But, when you first start out, you latch on to things that you think might be useful. And I remember latching on to the idea that Gann might be useful. So.
I found that interesting too, is I see traders that are profitable traders. They're on the right side, and they believe in Gann or Elliott Wave or Wyckoff or whatever their methodology is, and they believe in it, and it seems to work for them. I mean, I don't see the records, but it seems to work, and I'm like, what in the world is this? I don't have any clue. And the more I've looked at, even when we talk about the actual trading entries and exits, it's like they're all trading different things they believe in, but they're still capturing trends. And whether it could be random in nature or it's just it's simply ways to capture trends in their time frame. There's no magic behind it. And like one guy's using a moving average, and one guy's using an Elliott wave, and one guy's using a Gann fan or whatever, and they're all capture this trend. But it's the same principles. It's just they're using things that may or may not even work if you test them.
Yeah. Steve, do you have a one guy? I mean, Mike Nelson here is putting you on the spot a little bit. Perhaps he's putting me on the spot too. One trader that has made the greatest impression on you?
My goodness, that is a difficult one. I think Paul Tudor Jones, studying the trader video, his interview, and all the different interviews he's done. I've got a lot of insights from Paul Tudor Jones, and he actually talks about technical things inside of his systems here and there. And I think I've gotten probably more from Paul Tudor Jones interviews than anybody else.
Yeah. I don't know if I can really answer that. I mean, I can like tell a story about 6 or 7 people that were very influential, in all different times. I think, the first person to really see one of the first people for me to see up close and personal nearly 20 years ago, to see his office and to see how he operated, operated with me in the room, and to look at his track record. Bill Dunn, just fascinating case study to have that location independence, to know that he wanted to not be in New York City or Chicago and went to, frankly, like I think it was either north or south of Palm Beach. He's nowhere near really anything, just kind of a coastal town. And that was like, wow, okay, none of the other stuff matters. Once you see somebody that's that successful and you realize the rat race to him is not important and not part of his success, then that just takes off so much of the world's busyness and noise off your radar screen, and you just don't pay attention to it.
Yeah, the best thing a lot of traders can do is just turn off the financial news, turn off, using social media for any kind of trading, just turn all that off and just trade the system, trade price.
Well, that's an interesting thing for me and you, because we both have to be, if we're objective, we'd say, okay, Burns, Covel, you guys are out there in these various forums, giving insights, etc. But I would argue that, and I'm talking my own book, so to speak, and talking your own book. But I think generally there's a difference between trying to say to somebody every day, do this, do that, or I think this about the market today, versus trying to give universal insights and pass that along. I think that's a quite different way to operate, don't you?
Oh, absolutely. I think that's the real good use of social media is structure of methodology and systems and risk management and what can let somebody become a trader instead of giving some silly picks or stock picks or talking about their beliefs or their opinions about the future of the markets. I believe that's the big divide in the social media, which I think we stay on the right side of that.
Yeah, I'm not asking for credit from anybody for doing that, but I do like to think that I try to stay on that side of it. I think sometimes that can unnerve people. I think if you don't, because I think sometimes people just want to chit chat about the markets so much, and I look at it very rigidly. Like I don't really want to chit chat about the markets. I don't really care in that sense. I care more about, okay, is there a model? Is there a system? Are there rules? Am I following them? And that's it.
People ask me for opinions about some particular stock. I'll say, well, I'd have to run it through and back test the last 10 years to have any idea of what it's done or or what kind of system you could even create with it. I mean, there's just basic principles of trend capture. And
that could probably cause some people to think you're being evasive.
Oh yeah, and they don't. But some people, it makes sense. Some people it begins to make sense to them. Like, why would I have an opinion about this stock? I don't. That's nothing I've studied and back tested.
Yeah. Hey, there's a question here from Tony Stark, and he's talking about time frames. And this is an interesting issue, and there's various opinions out there. And he's talking about that maybe on a short-term time frame you could get a short signal on the same market. A longer time frame could be a long signal. And there's no doubt that he's right on the money in terms of that thinking. So it really becomes critical and if we're just talking to, quote, new traders or independent traders, retail traders, not a fund, but even funds do this these days. It sure seems like to me, I would make the argument from a standpoint of time commitment and the ability to have some freedom in terms of your location. It seems like the longer time frame gives you something much greater. And there's absolutely no evidence that by going the longer time frame, somehow or another, you're now sacrificing profitability. Because I think so many people instinctively want to think, if I stay closer in terms of that time frame, that's going to give me better odds or better this or better that. Whereas I look at it and I say, well, who the heck are you competing against at that shorter time frame? It's high frequency shops.
Yeah, the best way to beat the high frequency traders is to be a low frequency trader.
Yeah, that's a good way to phrase it. For sure.
So much intraday action is just pure noise, pure noise of algorithms fighting each other intraday. And I just, like you said, that's amazing. People try to trade inside that time frame with 7-8 monitors and sitting at a computer all day for 7 hours or 8 hours. That's just not the life I want.
Well, that's a good point you bring up too, the whole monitors thing. And we've joked about that online. Someone sitting there in some kind of command pod cockpit. I mean, how is a human being supposed to sit in front of 7 monitors and make better decisions and more efficient decisions than an Excel spreadsheet? It's just is ridiculous. It's all some kind of ego fantasy that people want to believe that the best traders are sitting in this command pod each day, for 12 to 14 hours a day, not moving, getting, what's that thing when you're on the airplane and you sit too long and, you can get a heart attack by the blood clot going up your leg. I mean, who the hell wants to live like this?
That's exactly right. That's that's not the lifestyle I aspire to.
Yeah, but you're also not sacrificing anything. Let's say part of your world happened to be trading a weekly bar. There is so much evidence out there. If someone is hearing just this point of our podcast, there is so much evidence out there for the idea that a weekly bar, like not looking at anything during the week except the closing price on Friday, and that's enough. But that's like counterintuitive for people.
Yeah, during a bull market, just trading simple moving average crossovers are just amazing. Just something simple as a moving average crossover system when there's a market in a bull trend, and you're just simply holding and making money. Simplest trading system there is.
You had a couple of tweets too that I thought were interesting. If I can keep you for a few more minutes here, you had one from Howard Lindzen, who's been on my podcast, and he said, "Nothing makes me cringe more than calling institutional money just smart money, calling institutional money smart money." And gosh, he's so right about that. So here we are having a conversation today, trying to talk to maybe people that are starting out, new traders, retail traders. And there's a difference between being for example, the trend following fund managers, the institutional traders, for example, the pension funds and all this kind of stuff. There's not necessarily any science there. There's just people with lots of control and power over big pots of money. And they just often, okay, let me take a step back. I was talking about this the other day with a very well-known trader and talking about how at some of the biggest pension funds in the world, that literally it's the representative from the local fire union and the local teachers union are sitting in these rooms with literally no expertise at all, and this kind of community group of people being influenced by some consultant hired by the pension fund to then make a decision to allocate to who knows what. It's just when people get under the hood and start to look and examine the entire playing field for a new trader, there's always going to be opportunity.
What always shocks me is the fact that the S&P 500 index, even the SPY ETF beats, like normally 80% of all mutual funds, beats most pension funds. The index, I mean, a lot of the professional money, so to speak, with the mutual fund managers and the hedge fund managers, they can't even beat the S&P 500 index, much less get fees on top of that. And I just, like he said, that's just, they don't know anything special.
And look, that's not hating, because I guess if the roles were reversed and you and I were running the Fidelity family of billionaires made off fees for not beating the S&P, I don't know. I mean, I guess I would be like, this is a great business. And, if I was in the middle of it. So I'm not trying to be I'm not trying to hate and say, these people are bad people or anything. But from a pure just being objective about it, they don't beat the market.
Yeah, just for the math alone, it's just, that's just reality. And they get paid well for not beating a standard index ETF.
Let's end on one tweet that I saw that you posted. It was a comment from George Soros. Quote, "My approach works not by making valid predictions, but by allowing me to correct false ones." End quote. Love that.
Yeah. I think the biggest thing, like we talked about earlier, that trips the traders up and new traders up is it's not winning percentage that makes you profitable. And Soros touches on that. It's the size of your wins versus the size of your losses that lead to profitability. The easiest path to profitability in trading is maximizing your winners and minimizing your losers.
We could talk for hours. And I think a lot of people will hear and maybe not hear. Some people will hear and get it. And I think it's always interesting to just think about these concepts for me. And does it register? Does it get in? Does it make it into those brain synapses and start to fire and get that excitement going? Or does it just float on over and people go to the next thing? it's a constant struggle, Steve, for trying to get people to awareness. Steve, where can we send people? Where's your best site to send people these days to check you out, to check your books out? Where's the best website we can send them to?
I blog daily at newtraderu.com and newtraderu, the letter U.com. And I'm on Twitter at @SJosephBurns on Twitter.
Yeah, you've built up quite a following in Twitter. I think you could probably open up a business teaching people how to do that. I sometimes look at your followers and I'm like, man, I gotta get out to. You're in Tennessee today?
Yeah, Nashville, Tennessee.
Yeah, I need to get out of Southeast Asia and get over to Tennessee just for Twitter training with Steve. So
yeah, it's fun.
But how long have you been on Twitter? I mean, you probably early on, I'm guessing, or
I think it was 2010. 2010 I started. I just thought it was fun. It's just a blast to be able to communicate and talk to people around the world.
How much of you, and I'm asking you to kind of talk about yourself a little bit, but how much of it do you think is you're being there early on versus I know you're also very active. So you're in the midst of communicating with and reaching out to people constantly. Or do you just see it a combination of both issues, being early and then also constantly working at it?
Yeah, I think I give away so much free content. I just do a lot of blogging, a lot of free content, a lot of interactions. I think I just try to create value where people want to follow me to see what I'm posting that day. It's really just a huge amount of value creation.
It's a lot of work. People don't understand. I mean, and it's like how to constantly. Are you working on the book right now?
Yeah, we're working on a moving averages e-course and book. Mm-hmm. Just looking at what all the legends have said about moving averages and different ways to create systems around them. Yeah,
I'm sure you saw the comments from Paul Tudor Jones and Anthony Robbins' book.
Yes, that's exactly. Funny you say that. Yeah, that really got my juices flowing when he really talked about it.
And that's, and I'm not going to, that's a whole, we'll maybe save this for the next conversation, but that's another story in itself, is that I'm actually a big Anthony Robbins fan. People might think negative things about him sometimes, but I really liked one of his first books that I read early on. It kind of changed my thinking about how to gather information. But I do think that his book should have been, in my humble opinion, more of a market wizard's homage versus a how-to, because he took, 12 to 14 of the most successful billionaires, all of which had an entirely different strategy, and then said, we're now going to pull something from this. That's very difficult. That's very difficult to do. They were so disparate in how they got success. Whereas I always thought the Market Wizards books, there was a common theme. Mm-hmm. There's always a common theme in the Market Wizards books. And you can read those and say, like, gosh, these guys all come from the same neighborhood, so to speak. Whereas Anthony Robbins' book, they're not from the same neighborhood. That's a whole other conversation. That's my opinion.
Yes.
So newtraderu.com, Steve?
Yes.
Okay. Listen, appreciate you taking the time today, sir.
All right. Thank you so much for having me, Michael.
My offer to you is really simple, very straightforward, no BS. Go to iTunes, covel.com/iTunes. That's covel.com/iTunes takes you to my iTunes page. Simply write a review about this podcast. Let me know what you think. I will then send you a free CD and DVD of Trend Following Extras. I appreciate your support, and believe it or not, this simple little process of going out there and expressing that you enjoy this podcast helps me to get the smartest people on the planet on this show. So again, thank you for all of your help, and thank you for listening.